Welcome to ForexTV.com. Today is Wednesday, March 4th. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is giving up ground to the euro, Aussie, and pound, and continues to gain on the yen. Now let's take a look at the headlines. Stocks rose around the world, commodity prices rallied, and Treasuries fell on speculation China will broaden efforts to boost growth, and U.S. lawmakers will reach an agreement on a plan to stem mortgage defaults. Service industry shrank further in February, and companies stepped up staff cuts in the U.S., offering no sign that the pace of economic decline is abating. The Institute for Supply Management's index of non-manufacturing businesses, which make up almost 90% of the economy, fell to 41.6 from 42.9 in January. Readings below 50 signal contraction. The ADP the Employer Services Survey showed employers cut a larger than projected 697,000 jobs last month. Today's figures indicate the economy's contraction this quarter may be at least as big as the 6.2% annualized slide in the last 3 months of 2008. The job data also reinforced forecasts for a Labor Department report in 2 days to show the highest rate of unemployment since 1984. Survey of the private employment of the U.S. ADP showed that number had dropped. Economists had been expecting 630,000 decline in employment in the month against the previous print, which was 614,000 from a reading of 522,000. The services sector led the way with total loss of 359,000 jobs, following a loss of 279,000 positions in January. Goods producing sector shed 338,000 jobs, marking the 26th straight month of decline, while manufacturing lost 219,000, marking 3 full years of decline in the sector. Stocks still climbed today despite the news boasted by the Chinese authorities considering additional stimulus, and crude oil futures are now trading up $2.36 to over $40 a barrel. Gold is down slightly to $910.70 an ounce, and at this point more than 8.3 million Americans owed more on their mortgage loans in the fourth quarter than their homes were worth, as a recession cut values by $2.4 trillion last year. That from a report from First American CoreLogic. Another 2.2 million borrowers will be underwater if prices decline another 5%. That according to the Santa Ana, California-based seller of mortgage and economic data. Treasury today issued eligibility guidelines for homeowners seeking federal aid that will allow troubled borrowers to lower mortgage rates to as low as 2%. The rules require applicants to fully document their income with pay stubs and tax returns and sign an affidavit attesting to the, quote, financial hardship. Today we're joined by John Netto, Chief Investment Strategist at Net Black Capital. John, welcome to the show. Thanks for joining us today.
Thanks for having me on the show. I appreciate it.
John, that was a rather long-winded introduction. I appreciate you staying with us. It looks like the London session caught a bid for risk, as this Chinese announcement overnight suggested that that the Chinese could in fact be the savior here and drag us out of this recession. What are your thoughts on the risk trade and what are you doing in the face of this?
I think the risk trade encapsulates a greater perspective that we have to take on the markets, and that is, what is the overall market sentiment? And as you read off from the aforementioned news items, there's a great deal of abysmal economic data out there, but we see from time to time that while sentiment predominantly bearish as it is, does shift and take on a more short-term bullish nature. And when we talk about risk, when people do take on more of an appetite for risk, we see a rally in the European equity markets. We saw the DAX and the Dow Jones Eurostoxx and the CAC put in meaningful gains into their session closes. We've also seen currencies like the Aussie dollar show some strength today despite some pretty negative or worse than expected GDP numbers that came out of there. So we see short-term technical bounces that take place, but in the context of the longer-term macro trend, this probably presents an opportunity longer term to sell some of your longs and maybe establish a more of a short book in your portfolio.
John, let's isolate Aussie right now. Aussie has jumped over 200 basis points, literally a half hour after the more than expected drop in GDP that we saw overnight. That was about 7:30 last night, and at about 8 o'clock we started ascending the ladder, about 220 basis points on Aussie. You think that's a short-term situation there?
Well, being a hedge fund manager, you see trades that definitely get crowded with a number of hedge fund guys out there and short-term traders. And it's a classic case of buy the rumor and sell the news. In this case, sell the rumor and buy the news. So when that number came out and we saw just how bad it was, it gave an opportunity to cover. And this is the kind of dynamic that when you deal with a market, which is a forward-looking mechanism, that they do begin to hope or price into over a short-term basis better economic data. And despite that negative data, we saw, I think, some short covering, and the markets take on more of a tradable range.
Gotcha. Now, with regard to your European strategy, can you tell our viewers, from a macro standpoint, the strategy that you take on, looking at things such as DAX for risk trade, and just dig a little bit deeper into the psychology or the methodology there, John? Sure.
There's two things I look at when placing a trade or managing a position, and the one is strategy and one is structure. And when I talk about strategy, it's, do I think the market's going up? Do I think the market's going down? Do I want to be long calls per se? I'd put a lot of derivatives positions on. Do I want to be long puts, or more esoteric strategies than that? And the second component is structuring, meaning what offers the best correlation, what offers the best risk-adjusted return right now. And if I think that the risk aversion trade's being unwound, the best way to play that may not necessarily be long just pure S&P equities, maybe long European equities. There's obviously a great deal of pressure that's come on with the whole rumors or innuendo behind the Eastern Bloc countries and Hungary and Poland currency coming undone, the European Union, Europe going into decline. So when the shorts come into cover, the best bang for the buck to play these moves is like long, maybe small caps or long European equity markets. In this case, the DAX provided a great opportunity, or some very good long opportunities today to play that upside move.
Yeah, we saw the DAX climb inordinate, when you compare it to the U.S. equities and also the rest of the European marketplace. What are you looking at going forward towards the end of the week, John?
I think the S&P, a lot of what we'll look for is as far as this week goes, I'm pretty market agnostic, actually. I think with the markets being what they are, with sentiment and the capricious nature that we've seen in terms of price action, you really have to stay dynamic. I think that longer term, though, gold is setting up for a very good long-term opportunity. I think it's become a potential replacement as a driver from a risk-averse standpoint. The yen's clearly fallen out of favor. We've seen that even with the equity sell-off, the USD JPY is net back near parity right now. So for me, the lower-hanging fruit is, from a longer-term basis, at least for the next couple of weeks or so, to begin to build a long gold position between now and about $8.85 an ounce. I think that sets up a great longer-term play.
Okay, great. Hey, John, we're going to leave it there for now. We really appreciate your insights, and we'd love to have you back again, talk about these things in depth.
I'd love to come back. It was my pleasure. Thank you for having me on the show.
Great. Thanks again. This has been your New York Forex Market Buzz with John Netto of Net Black Capital. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.